What is the topic that will most likely be tested in your SBR exam? Well, that is something new. That is something that is discursive, so not debits and credits, but rather perception of the financial statements. And this topic is likely to be APM and MPMs. Additional performance measures are measures of financial performance not specifically defined by the applicable financial reporting framework. So, for example, we have revenue. This is a normal measure. It is defined by IFRS 15. We have earnings before interest, tax, depreciation, amortization. There is no standard that defines it. This is APM. We have profit before tax. This is something that is defined in IFRS 18 as subtotal. This is not an APM. Sometimes you can hear the words additional performance measures, and sometimes it will be alternative performance measures. These terms can be used interchangeably because one of them comes from the European Securities and Markets Authority, and well, this most likely is the same, so don't worry, just use APM. Now, what are the measures that would be the most typical examples of APM? Adjusted profit. So profit that excludes some of the items that may be never met again. So for example, a restructuring provision or any one-off incomes like grant incomes. Free cash flow, net debt, economic value added, the one that you study in your advanced performance management exam. And of course, earnings before interest, tax, depreciation, and amortization. And with this very exam, you will have to talk about the benefits and drawbacks of including APMs. The benefits, of course, would be that it would allow to understand the users, the story. So, for example, when we're talking about operating profit, well, it's great, but if there are one-off incomes or expenses, it won't allow the users of the financial statements to predict the financial health of the company. And if we are going to exclude those very large items, one-off items, then the relevance is going to increase. It also gives the management the flexibility to show something that is the most important for their business, for their industry. So, for example, retail companies often use earnings before interest, tax, depreciation, amortization. There are some companies that would use something else in their own businesses, right? So that also allows investors and other creditors to value the company through the eyes of the management. So this is great that we have them. And with the APMs, we will need to show reconciliation with some of the lines of IFRS. So, for example, how to arrive from P&L to earnings before interest, tax, depreciation, and amortization. Now, as for the disadvantages, the problem is that management can actually create measures in order to present something that they like. And if you watched the movie We Crashed, you probably remember that they had this very measure, earnings before interest, tax, depreciation, amortization, and rent. So they decided to exclude rent expense, which is absolutely stupid for a company that actually rents a building in order to sublet it. And if you remember, it was a great scandal back then. And this is an example of a disadvantage, right? So the management may be perceived as manipulating the results. And there is no standard that governs the use of APMs, and this means that there will be inconsistency, and as such, the financial statements will become incomparable. So you will be tested on APMs, on the importance of them, on the examples of them, and you need to understand the difference between APMs and MPMs. MPMs are management-defined performance measures. We abbreviate them as MPM, not MDM. And these are subtotals of incomes and expenses. So it can't be, let's say, just different subtotals. So we can't say anything about assets or liabilities because it's not income or expense. It cannot be a subtotal of only incomes, such as adjusted revenue figure, because it's not subtotal of incomes and expenses in this very case. It cannot be a measure of non-financial performance, such as, let's say, square meters, because again, this would not be a subtotal of income and expense. So basically, it's just those extra lines that you would add to your P&L, and it gives a better understanding, but still it looks it is perceived as a more conservative way of showing the information. And of course, there has to be a disclosure that is going to show how the MPM has been calculated. We expect that with higher probability, it will be APM that will be tested. And as such, you need to be prepared how to talk about pros and cons. And my name is Lilia Kirilenko. Thank you for listening to me. Make sure to subscribe to SBR Made Easy podcast and join me for my SBR course. Bye.